Mic test, mic test. So can anyone here, if can someone can try to type something in the chat so I can confirm before I proceed. Okay, thank you. Okay, thanks for joining tonight our webinars. Tonight we'll be actually sharing more about margins and what is actually margin. But before that, we'll cover some of the topic that we covered before. Is actually more about selecting stock for dividend. So okay, most of us actually do like to have passive income where we do not need to do anything, and the stock can actually help us to generate passive income. So what we are looking out for is actually dividend. So first of all, we need to actually before we even start investing, we need to actually set our investing goals. So we'll be covering that. After that, we'll follow by asset allocation, followed by analysis, company case study, putting them as a portfolio, and lastly, actually how to actually put them into a margin. So first of all, everyone is very unique. Everyone have so-called different income, and also your investment goal will be actually different. So you always depend on your different factors. Like for example, what is your age group? Whether you are young or you are maybe towards a mature generation, or whether you have a lower income or you have a higher income, and what is the outlook of your view from the economy. So all this will actually affect your investment goal. So do take note that investment goal is always a moving target. It's not like, okay, I set this goal and after that, I'll just leave it and let it to run. But because you know that as we grow older, right, our priority in life also change. Maybe when I'm just graduate from uni, my focus is just to get the first income. Subsequently, I have settled down, have my families. Then next thing is I want to have my own house. Subsequently, maybe you have children and you have a car, all this. So you know that all your life goal always change. So your investment goal will always change with your life goal. So that is very important. So what we always say, setting a smart goal. So I think this one everyone heard about this, whether is it in your life or working, you always face this. So first is specific. You must make sure that each of your goal is very clear and specific. And you also must actually measure the goal. Like let's say you set a goal of 10 years, but every year you also must continue to do review. You must continue to review whether your existing portfolio is able to actually hit your target. Let's say you hope to achieve a passive income portfolio, maybe giving you 10K per year down the road. However, you can see that the first year is only giving you 500, then subsequent second year only give you 1K. Then you might have to review your portfolio, whether how much are you putting into invest and whether your stock are really performing to give you the returns. And also next stage must be achievable. So don't expect investment in stock, like for example passive income. You want passive income give you dividend of 20-30%, but it's not possible because you have to look at the overall investment environment. You can see, especially with the low interest rate, the expected return of the investment will be also lower. When interest rate increase, then we expect higher return on our investment. And also must be relevant to your life. Just like I mentioned, everyone life, as you grow older, your life goal will always change. So this investment goal must be also related to your life. And also set a time frame to each goal. Like for example, on a yearly basis, you review your portfolio and see whether you are actually meeting your goal in the 10 years down the road. So let's say you are age of 30, 100K, and you aim for age of 55, 800K will give you an annual, and hoping that give you an annual return of 5%. Then you also, before you actually go even into investment, right? Actually, there's some things that you need to know. First, you have to have your protection, like a hospital plan, and also your so-called accident plan, or this, and also some term insurance or life insurance that will actually cover you in case there's uncertainty. It's a kind of hedging against any uncertainty. Then also always have around 3 to 6 months of emergency cash on your hand, because especially in this COVID-19, you can see that our job, right, so-called responsibility and role, all this also change along the way, because you can see that sometimes this job role may become irrelevant. Then you may have to actually switch a job. So sometimes you may have a loss of income for a few months. So that's why it's very important to have around 3 to 6 months of emergency on hand before you start investing. Then let's say assuming a 5% average return over a long term and you also reinvest. So what you can do, maybe you want to do dollar cost averaging or value averaging, which I shared previously in my webinar. We talk about this kind of strategy is a so-called a safer approach where you slowly put funds into the market and build your overall portfolio. Then subsequently, you can see that along the way you may get married, you might buy a house, you may have pay increment, you may have buy a car, have kids. So you need to adjust your investment plan accordingly. So always carry out periodic reviews of your investment. Maybe is it quarterly or is it yearly? And along the way, because just now you only talk about investment in stock, along the way as you grow older, right, you want to have a more so-called defensive portfolio or safer portfolio. What we want to go is actually fixed income instead. Fixed income instead will give you lower returns, but it's actually the fluctuation will be actually lesser. So asset allocation is very important. You need to always balance risk and rewards. So asset allocation, just like I mentioned, all this depend on individual because everyone have different risk tolerance, time horizon, and investment objective. So in general, we are talk about three main asset class in this webinar, but in reality, right, there's much more asset class. So when you actually invest, give me a moment. So let's say you walk into you're at night, you're walking at the dark area and you're not able to see. Will you actually take a step in front or will you switch on your light? So that's why you come to this. Let's say in front is actually a cliff. So if you do not switch on your light and you straight away walk straight, right, you can fall off the cliff. So in investment, right, without considering all this risk tolerance and also what kind of investment is like sleepwalking to the edge of the cliff. We see a lot of client, right, actually when they do investment, right, they always actually follow just blindly with their friends or colleagues or this. Even actually when I started investment, right, my first investment was actually didn't end well because my friend, my colleague just tell me, this is a good investment that I just follow them. Because for me, I'm going to come from a so-called financial industry. I used to work in the chemical industry. So everyone say, invest in this, you just follow. However, some of these investments actually end up didn't do well. And also I didn't continue monitor, actually also didn't do well in the field. So when you are investing, right, you need to consider what is your risk tolerance, how much of your loss you are prepared to handle within your portfolio. If your risk tolerance is actually low, you may want to consider a higher percentage in bonds as a smaller portion in the stock. Because bond-wise, the price fluctuation will be smaller as compared to the stock. Also, when you are growing older, you may also want to consider higher percentage in the bond. So why you want to consider risk tolerance? You don't want to have a so-called, let's say during this COVID-19, during March, February, how many of you actually have sleepless night when you look at your existing portfolio? If you are unable to sleep because of your stock investment, right, that's why you are actually taking much more risk than you are able to tolerate. That's why you are unable to sleep. You constantly look at existing portfolio. Oh, how much money actually I make a loss? So if you are really worried about this or this, right, maybe you want to actually start to lower down your percentage in the stock and higher allocation towards the bonds where there's less price fluctuation. So there are a few different types of strategy to invest. One is actually known as strategic asset allocation. You just set a target asset allocation with various class and rebalance periodically. So when the portfolio is actually drift off, because different investment, right, will give you different returns. From there, you need to actually do periodic readjustment of your investment. So this is actually more compatible with a buy and hold strategy as compared to a tactical asset allocation that's more suitable for active trading approach. So I think I shared this example before. So let's say you are actually client A, you are 30 years old, so you are younger, you have actually higher risk tolerance and your investment horizon is much longer. For RMB, you are 60, so you have very low risk tolerance and you prefer a more stable income and less price fluctuation. So you can see that actually for currently, they will allocate a higher percentage towards equity, which give you a higher return as compared to fixed income. For older generation clients, right, you will prefer a higher allocation towards a fixed income, so you have less price fluctuation. So we also talk about tactical asset allocation is actually more active management approach of a portfolio. Oh, okay, maybe I go back first. So at the end of the year, right, actually you need to do rebalancing of your existing portfolio. Let's say you see for asset equity, right, give you around 12% return in 2019. So at the end of the year, you can see a percentage in equity is higher, your fixed income and cash is lower. What you want to do, you may want to actually shift some of your equity and shift towards the fixed income and cash. So you always try to maintain the asset allocation with the 70, 20, and 10%. And for client B, you also continue to do adjustment along the way to actually fit into his target. So tactical asset allocation is actually more toward active management approach. So we always shift assets to take advantage of any market price anomaly or strong market sector. So for example, you know actually about business cycle. At different stage of the business cycle, different sector will actually perform differently. For example, if you are talking about towards the early stage of this economic recovery from the recession, right? People will be actually looking into finance industry, property, and consumer discretionary. So all these sector are expect to actually perform well. So when the people are actually thinking recession is going to end, what they'll do? They'll start to shift their asset allocation towards this sector to enjoy the strong market trend. If they are going toward recession, people will start to shift their asset allocation to a more defensive, like consumer stable, and also more toward healthcare that are more resilient during this period of time. And sometimes they also may shift some of their asset. Let's say they think that the market is actually run up quite a lot, and next is they expect some sort of recession. They also may shift their assets toward cash or safe haven asset like gold to keep it also. So let's say tactical asset allocation currency, it used to be actually 70% in equity, 20% in fixed income, and 10% in cash. But he expect that, let's say COVID-19 is coming. He see that actually there's a it's actually getting worse. What we want to do? So during February, he may want to actually start to rebalance his portfolio. Oh, it's coming possible recession. What I want to do? Reduce exposure to equity, increase some of my exposure to fixed cash, and I hold some cash. So in case the market really come down, right, then I can deploy my cash back into the equity and get some of this share at a lower price. However, I also do not want to actually stay 100% out, because sometimes we do not know because we do not really expect the impact of this COVID-19. At first, actually most of the world, you can see that actually most of the government say, oh, COVID-19 is just in China, it won't really affect us. You can see some of these government leader over around the world, right? They say that they try to downplay this COVID-19. However, when reality start to hit them, then they start to realize that. So that's why you can see that when it start to really hit them in March and April, right, the market actually start to tank. So so that's why it's very important. If you want to be a tactical asset allocation, you really need to look at the news, understand what is the market, and also what is the business cycle of this whole economy. Okay, so asset allocation, just now we just talked about it only was stock, fixed income and cash. But in reality, right, just within equity, there can be a growth stock, large cap, mid cap, small cap, global stock, and emerging market stock. So when you actually look at this, right, so in a case of recession, right, people will start to actually avoid small cap, mid cap, and emerging. But however, when economy start to recover, then actually funds flow will start to actually flow back into all this. So you need to understand this also. And also in reality, there are much more type of asset like real estate. Now I think real estate is very popular, especially you can see that a lot of people are actually trying to buy all these condo landed property, especially with this low interest rate environment. Also, gold is actually will be actually expect to do well in low interest rate environment. However, gold have also is a opposite of so-called equity. If equity is actually expect to do well, then gold will actually start to drop, because for equity wise they give return. However, for gold, right, it's actually just the only price appreciate, but when the actually stock market give you better returns, right, people will actually throw so-called sell their gold and go back to the equity market. Fine arts, and now I think one of the most popular is about cryptocurrency. So you can see actually recently quite a lot company go into cryptocurrency, PayPal, all this. So it's something that you also can consider inside your portfolio. And also commodities also, like your oil, all this. So when we are investing, I think I share this quite a number of times. It's a rule of 110. It's actually a guideline of how much money you can invest. You should can consider investing in equity. So how to calculate this is just take your 110 minus your age. Let's say you are 30 years old. So you can consider around around 80% of your equity in 80% of your allocation in the equity. However, if you are 50, means that only 60%. So do take note that this one is just a general guideline. It doesn't take into account of your individual risk tolerance, time horizon, or investment objective. So actually, if you really want to plan a portfolio, you can actually find your trading representative to understand actually what's your risk tolerance, how much you are willing to invest. And also upcoming webinars, one of my colleague, Athena, will be actually sharing more about this portfolio for your own portfolio management also. So analysis, so when we are investing in all these dividend stock, right, before we actually build a margin portfolio, we need to actually look at all this ratio to see whether all these company are actually doing well. So we'll be looking at their profitability, liquidity, sovereign, dividend, and other factors. So net profits. So this is the calculation. I don't go through so much. So it's actually we are generate how much net profit each dollar of sales generate. Let's say it's a 50%. So means every sales $1 sales that you generate, you give the company net profit of 50 cents. So we always prefer company that have higher net profit margin because they are making more out of their sales. We also need to actually examine the net profit margin over time to give us insight how well the company is performing. So if you can see a company net profit margin, right, has been decreasing over time. Let's say at first it made 80%, then start to 50%, 40%, 30%, 10%, then after it's go negative. Then you have to start to worry whether this company is really going to perform well in the future. So that's why net profit margin tells us how well is company doing. So we actually prefer company that have slowly increasing net profit margin over time, or at least a stable net profit margin over time. So there are some limitation of using this because net profit margin comprise of operating income and non-operating income. So operating income, like for example, you just talk about Sheng Siong. So their main business is actually in groceries. So the revenue, all this consider earned from their grocery rate will consider operating income. However, let's say they do some investment, stock investment, and they make some money. So return on this and they sell off subsequently. These are actually considered non-operating income because they do not generate from their normal daily sales. So we actually prefer company to actually generate most of their profit from normal operating income because these are actually more sustainable than non-operating income. Next thing you will look at is current ratio, current asset over current liability. It is a measure of how the company ability to pay short-term obligation. It's also known as the working capital ratio. If there's less than one, means that the company might have issue paying off their liability. It means that all these current assets can't even pay for their current liability. So some limitation of this current ratio, because in some of these current assets, right, you cannot be liquidated easily. Means that you want to sell off this, right, you cannot sell easily, and sometimes you might have to sell at a much lower price. So that's why this current asset may not be actually valued at the current price. And also change in inventory value methodology. And for example, company do first in, first out, or last in, first out. All this can actually affect the inventory value. So I think this example I shared before. So let's say we talk about first in, first out. Let's say I buy two stock worth of $10. Subsequently, I buy another two at $15. So when I sell, right? So first in, first out means that the first one that come in, I must sell at the first one come out. So end up, and at the end of the month, I'll have this balance of $30. Last in, first out means that you buy 10, buy 15, you have to sell the last in to come out in. So it'll be actually at $15. So end up at the month you only have less balance of 20. So you can see the different how company may do manipulation in their inventory. So that's why it's very important to look at company whether they actually keep on changing the inventory valuation methodology over time. Like there's a lot other different kind like so-called averaging also. So you need to see whether company actually try to do manipulation in terms of their financial result. Quick ratio, they remove the inventory, so help you to solve the problem of inventory. So means that the company ability to pay short-term obligation with their most liquid assets, known as asset test ratio. If it's less than 1, means that the company may be heavily rely on their inventory or other asset to pay for their short-term obligation liability. So some of these limitation, account receivable is like, let's say you actually so-called sell the goods on so-called to someone on a credit term, and subsequently you receive the money maybe 30 days later or a few months later over time. So however, sometimes when you, let's say you lend money to your friend, sometimes if you want to actually get back this money, right, it's not so easy, and sometimes they may not be able to return. So same thing for company who are selling goods on credit term, they may not be able to receive the money. Also, for this limitation, is actually not suitable for all business model, especially supermarket, because their inventory is what they actually use to generate, and the inventory turnover is very, very fast for especially for supermarket. So it's always coming in and out. So this ratio may not be suitable for business model like supermarket. Another one we will be looking at is actually stable free cash flow. So it's actually represent a company generate after account for their cash flow outflow to support operation and maintain their capital assets. So it's available cash for company to repay any creditor, pay out dividend or interest to the investor. So cash flow is considered much more cleaner because you look at the cash instead of net income. All this we can be actually subjected to manipulation. Also, cash flow can also help you to review problem in the fundamental before they even arise in the income statement. You can see actually, let's say the company has so-called has problem already, stable free cash flow has been actually dropping over time. Subsequently, you still have to maintain your existing assets, like for example your factory or this. You need to or maybe your machinery or this. You need to continue do maintenance of all this. If you are not able to see the cash flow start to having issue to actually do all this kind of maintenance works, but you can see that actually in the future they might have problem to even pay out repay creditor or even pay out dividend. So this cash flow is actually one of the useful ratio that you can look at. So some of this limitation of this free cash flow, let's say I buy a new equipment, and this free cash flow, right, will be only affected on the year of purchase. Let's say I buy 100K machinery, and it's actually so-called I'm going to use for the next 10 years. It's like for your car, maybe you buy 100K, you're going to use for the next 10 years. And that's when you buy car, right, there's depreciation cost over time. However, from the point of cash flow, right, means that I have to upfront pay of this 100K straight away. So this one, sometime when you pay out 100% of this asset in the first year, then you can see actually that year, right, your cash flow will suddenly, the free cash flow will drop significantly because they pay most of it upfront. So it also depend on how company actually purchase the asset, whether they're actually slowly paying all time or maybe they pay out everything in the first year of the purchase. Next thing, you need to look at the debt to equity. We talk about short-term debt and long-term debts over the shareholder equity. So it's a proportion of debt and equity structure in the company. It helps us to determine whether the company is too dependent on debts to run. So for company who are too depending on debts to run, right, when actually economy start to slow down, right? Because when you have debts, let's say you buy a house, you can finance, I think HDB, if I'm not wrong, you can finance up to 90%. However, when let's say suddenly economy doesn't do well, you lose a job, touch wood, so you might have problem actually paying down on this loan issue. So same thing for company. When they are actually too depending on their debts to run the daily business, right? Let's say economic slowdown, they may not be able to generate sufficient revenue and profit during this downturn. And that's why you can see actually SIA has faced this issue, because for airlines industry, right, when they buy airplanes, right, they have to incur a huge debt. So when they actually subsequent, when economy slow down, they are unable to generate revenue, they have issue paying off all these loan interest and debts already. That's why SIA has been actually raising funds over the past few months for their airplanes and their debts or this. So you can see that if company is too depending on debts, right, it's actually not healthy. Then you can see that actually dividend was likely to be cut also. So by examining the debt to equity ratio, right, also can give us how well a company actually managing their debt. If a company, let's say, or starting off, they start off with maybe 20%. However, when over next 5 years they increase to 70%, well, you have to start to worry. This company is not managing their debt well. Next thing, whether they are going to pay you dividend, because when using margin, you want to actually use the low interest rate and invest into a stock that can give us higher returns. So limitation of this debt equity ratio, it doesn't consider the portion of debt that is due in the near term or the long term. Because sometimes some debts, right, maybe so-called in short term, maybe next 1 to 2 years, and some debts maybe a long term, next 10 years. So all this debt to equity, they doesn't consider the time frame of this. Interest coverage ratio, this one I think is earnings before interest and tax over the interest expenses. I think this one is actually a very important ratio, especially for REITs, because for REITs wise, they have to meet the so-called interest coverage ratio of 2.5 times by 2021 or 2022. I can't remember the exact time frame, should be 2022. So this one is actually help us to determine how easily a company can actually pay off interest on their outstanding debts. A higher ratio is better because they are able to actually pay off their interest expenses for the next few years. So this one is also important, same as the debt equity. So you can see how well the company is actually able to pay off. And if the ratio is actually declining over time, same thing, the company may not be able to pay off their interest expenses in the future. And if it's below 1, they can't even generate sufficient revenue to pay their interest expenses. And how are they going to actually pay for your dividends? That's why all these ratios are very important. You don't just look at the point of time, you always look over a period of time whether the company is actually really managing well. Next thing is that most of us actually want to invest in this stock for passive income. So you need to look at their payout ratio. So use us to assess a dividend sustainability. So higher ratio means that they'll have likely to have lower growth because they use to pay out most of their income. And do take note, in case company are always paying out more than 100%, how are they actually able to generate such kind of income to pay out more than 100%? That's actually a kind of worrisome. Next thing you can see dividend cut. This one I think later we can share some example inside the case study. Also, we look at the track record of dividend, see the consistency of company paying out dividend over years. You can see, we just see over the past 10 years whether this company dividend rate has been at least consistent or has been slowly increasing over time. This is very important, especially when you want to do investment. But if it's actually decreasing over time, then maybe you want to avoid that already. You do not just look at percentage, you also look at the number, because if you just look at percentage, right, because every year the share price also do change also. So what you want to see, we also see that every year what is the amount and also what is the share price. If share price is also decreasing over time, right, That's a worry sign because end of the year you may be making a bit off on your dividend. However, when you see account for the share price dropping over time, and then it may be not making, it may be even making a loss already. So yeah, some companies that have some of this issue. And for REITs, it's actually required to distribute 90% of their taxable income for shareholders. So people actually like to invest in REITs, but do think not all REITs are equal. Some REITs are actually not so well managed. You can see actually the long-term depreciation of the share price. One of them is actually Lipoma Trust by the Lipo Karachi because of their debts issue of the sponsor. So for some of these stock, right, REITs, right, they also have sponsors. So it's also important to look at the sponsor. I also do look out for actually non-recurring special dividend. Maybe they sell off some of their assets or some of their business during this period of time. Means that in the future, you may not be able to generate that same amount of income because let's say I sell off my asset that able to help me generate around 10%. Short term wise, I can see very special dividend. However, long term wise, right, next year I will see that actually, next year I will lose out 10% of the net profit of the dividend from this year. I also take note of scrip dividend. Scrip dividend, many clients always ask us whether is it a good opportunity, should I actually so-called get cash or should I actually reinvest? So there are a few conditions actually we talk about this. First of all, we say whether to get cash or scrip. First of all, you look at the cash. Actually, do you really need the cash straight away? If you need the cash, maybe you actually straight away take the cash. However, if you do not need the cash, then you have next thing you have to study the price of the reinvestment price. So next thing is that let's say I look at the price. Currently the market is trading at 2.4 and they actually allow me to so-called reinvest at 2.2. Then this will be attractive because let's say I take the cash and I reinvest, right, I have to buy at 2.4, and considering that I also have to incur some brokerage charges, commission to actually buy this stock. So sometimes scrip dividend actually offer opportunity to reinvest. I also do take note of dividend taxes. In Singapore, for us, stock investment is pretty straightforward. But if we are investing in overseas, right, some of these overseas will have actually dividend tax. Like for example, US actually have a withholding tax of 30%. And do take note, 30% is just a general guideline. It's also depend on how the company actually structure their dividend payout. Sometimes it may even be required to pay out more or sometimes less. So this one is just a general guideline. Next thing is capital expenditure. So it's the funds used to company to acquire, upgrade, maintain physical assets like property, plant, building, technology, and equipment. So you have to think about the change in the so-called capex. How is actually the property so-called all these property, plants, and building equipment, all this, and also what is the current depreciation. So it's actually important for company to maintain existing property and equipment for or to invest in new technology and other assets for growth. However, you do not want to invest in a company that always have very high capex because just now I say economy can slow down anytime and can happen. So that's why you do not want to actually so-called have this kind of stock, or maybe you want to have a lower allocation of this kind of stock inside existing portfolio, especially for dividend. So some industry will have very high level of capex, capital expenditure, like oil exploration, production, manufacturing, and also we talk about airline, the airplanes. In case of any slowdown, job and revenue will not be able to actually finance all this. Then next thing is you'll face a lot issue. And also, just so we talk about business cycle, so you need to understand business cycles. From there, you can understand what is the sector trend. Like for example, cyclical sector, they tend to be very volatile and tend to follow the trend in the economy. So they sell goods and services that many people will buy when the economy is doing well, but cut down when downturn. So oil sector and tourism sector are these two sectors that are very easily affected. And also we talk about non-cyclical stock. So they are always in demand regardless of any economy. They always outperform the market during economic slow down. They are more towards defensive. It's actually some of these are actually consumer staple and also healthcare. And also technology wise, right? I expect technology, some of this technology will also start to fall into this defensive stock because you see that technology trend is actually growing very, very fast. Every few months or every few quarter, I can see new technology coming out. So some of these are data center, especially with IoT, especially with 5G, especially with blockchain. All these right will actually require a lot of data storage also. So actually, I'll say that data center in the future will expect to be actually very defensive also. So it's when you want to build a portfolio, it's always good to have a higher percentage of non-cyclical stock as part of your portfolio because you don't want your dividend to be affected significantly. So this is an example of a business cycle. This one I always take from the feeder sector investment. So do take note that past cycle may not be represent of current cycle because they talk about technology. Technology last time technology used to be negative in the recession because everything was slowed down. However, you can see that during this COVID-19 cycle, technology really outperformed well. And also communication services also do perform well because you can see that especially with all these Zoom online services, everyone is actually working from home, so all these will actually tend to do well. So this is just a general guideline, but you still need to understand what is the business cycle out there and what is the economy doing and what are the government planning to do, what is their plan going ahead. So next thing, let's say you can see that actually most of the government in the world, they are going towards some of the general trend you can see. First of all, smart city, IoT. So this stock will expect to do well. Next thing you talk about clean energy, EV, car, solar energy, all this you can see all this already start stock investment already start to do tactical asset allocation into all these sectors already. So you can see from understanding news, right, you can see actually daily news. From there, you can actually slowly see what are the investment sector that you can keep a lookout for and how you should actually start to allocate assets. So just now we talk about some simple case study before I actually see how to understand companies. I think I shared this quite a number of times also. Asia Pay TV Trust is a very popular business trust, popular for dividend stock. So you just used to pay more than 10% return. So you can see their net income margins has been actually decreasing over time. I haven't do the latest update, but this one is just used as a case study first from 2014 to 2017. I even did invest in this stock before, but lucky actually I get out even before because I use this ratio. Something is wrong with this business. They are actually paying out more than 100% of their dividend. Wow, how are they going to sustain? Next thing is that you can see that actually their debt to equity rate has been increasing at over 100%. So next thing is that they have to announce a cut in dividend because they are using debts to pay out dividend. It's not sustainable. So I think last time I used to write more articles. Actually, we did a certain now HQ article or discuss about is this stock sustainable, so-called able to sustain their dividends. Subsequently, when they actually announced a dividend pay cut, the share price dropped to around 10 cents plus, and now it's still at 10 cents plus. So you can actually see that actually business when they actually go into get in trouble, right? They'll always show some early telltale signs, right? It's not immediately or they'll straight away get into trouble. So you can see that actually their so-called financial ratio, right? They deteriorate year by year or maybe quarter by quarter. From there you can see actually maybe it's time to actually cut loss already. So this one is another example I think many people will understand. So maybe you want to share whether will you invest or hold into this stock, especially at 2011, 2012. After that, will you still invest or hold into this stock? You can share your view inside the chat. Okay, so I understand that some of you say that you won't even invest or hold on to this stock. First of all, you say, wow, cash flow from the operation, their normal operation is already not making money. Next thing is their profit margin also has started to drop. Their interest coverage ratio has also dropped. How are they going to pay for their outstanding loans, interest expenses? Next thing, your debts has been actually increasing over time. I think this one is actually a very popular stock. There's already a lot early telltale signs that actually you should exit around 2012, 2013 already. So this is actually Hyflux. That's why you can see that when you do invest, right, early stage it may be actually a very good investment. However, you need to also take note. Suddenly you see that actually all these are actually start to deteriorate around 2011, 2012. So let's say you invest in 2013, you get the upside, and subsequently has been getting dividends over time. However, in 2011, 2012, you can see actually there start to be telltale sign that the business is not doing well. So from there, you can see that actually there's still a lot of opportunity for you to actually exit. You still can, let's say you enter around 30 cents, 40 cents. From here, even you exit at $1, right, you are still making profit. However, some people actually, they don't really look at the financial, you just see, company is still there, you'll continue to operate over time. However, you can see actually the business is not doing well, the ratio has been deteriorating. The share price will also continue to deteriorate over time until now it's still suspended. So that's why you say that business, right? When you look at financial ratio, you do not just look at a one point of time. You look over a period of time. Maybe it's a good business, maybe actually so-called a good stock, maybe a good investing during a certain period of time. However, when fundamentals is deteriorate, time to really cut loss. Cut loss is very important. Last time when my first stock actually I did invest is so-called Ezon is also oil related, and now it's still suspended. I don't think it can really come back. So that's the first stock that actually I did investment. I just follow. Then after that, it's doing I just blindly follow. So that's why it's very important to understand fundamental ratio when you're investing. So this one is actually another stock. So you can see actually profit margin has been actually around 4% slowly over increasing time. The dividend payout uh used to be high, but subsequently actually go into a more sustainable. And their debts, although you can see almost zero, but subsequently actually increased to around 20-30%. Then their actually earnings per share has been increasing over time. I think for 20-30%, if they do not actually continue to increase, right, it's still good. So would you actually invest or hold onto this stock? Maybe you want to share your view. Then later I share with you what company is this. Okay, I think some of you mentioned that you may consider holding or investing into this stock. Some of them no. So people are worried. First thing is that the debt to equity. So sometimes we need to also see, why the company suddenly have this debt? Whether they are using this debt to expand business and whether they are actually able to maintain. So this one is actually a Sheng Siong. Uh, okay, I think I didn't show over time. I need to show a longer period of time. This one is just a 1 year. I should actually show you 10 years. So actually, during this period, Sheng Siong has been actually using some of this debt. They expand, build more branch. So you can see actually Sheng Siong, right? I think it's last time it used to only start in Woodlands. So I stay in Woodlands, Marsiling area. So I understand their first branch. After that, they start to expand in all the neighborhood. After that, they expand around Singapore. So you can see actually they are using these debts to actually grow over expand their business over time. So actually do think note that sometimes debt to equity they may increase. However, if they increase a bit and they may want to look into this business. Actually, why they are actually doing this? Because they are actually trying to expand business. So you can see actually their earnings per share has been still increasing over times. So that's why you can't just use one ratio. Sometimes when you use multiple ratio, then you see got one ratio got issue, then you want to look further into the financial statement. Oh, actually they are going to expand business. So to open more grocery store, first of all, you need to actually do rental space or you need to purchase the property area. After that, you need to have so-called increase to purchase all these goods to actually do turnover also. Because for all these grocery supermarket, right, you need to have product inside. So that's why they need to actually increase some of their debts to do this purchasing. That's why debts to equity did increase. Subsequently, the share price still actually do well. So one thing is that I think many people will be worried about this. Just talk about Sheng Siong. So there's actually a support line at around 1.5. So you can see that actually has been resilient. So let's say if you are going to invest, right, you may want to keep off a support level at 1.5. In case it reach this 1.5, you can see the next support level is actually will be around 1.380, so it can drop around 20 cents. So Sheng Siong, why there's a drop recently is that it didn't also really win the digital bank license, because they actually joined partner with a few companies to go for the bidding, but end up they didn't get. So this is something that may affect the stock performance in the short term also. However, long term wise, I'll say that Sheng Siong will continue to be a defensive stock, because grocery most every day is a daily routine needs that we will need to do. Next thing is that this stock, first of all, you can see that profit margin has been stable around 10 to 11% over time. Dividend payout has been slowly increasing. Their debt to equity has been maintaining well, except for 1 year that actually did maybe some acquisition. And also their diluted earnings per share has been increasing. I think someone already answered, okay, I will invest. So actually this is, okay, I think, some of you will still consider. Okay, yeah, maybe, because sometimes we look at the ratio, right, then we need to understand more about business. Then we will decide to invest or not. So I may be a bit biased for me, because actually this second company that I actually work in before I come to Phillip is actually Airliquide. I think current share price still around 130, 140. They did have a drop during COVID-19, but subsequently still continue. So why the business is actually a industrial gas manufacturer? They have a wide range of business serving electronic, healthcare, large industry, also, and all the different, even the F&B, all this you also need, like your dry ice is actually carbon dioxide. So you can see actually they serve a wide range of industry. So actually their stock performance has been actually doing quite well. So our Phillip Security, right, actually also offer investment into this so-called French or France stock. So you can see that actually there are quite a lot of interesting stock that is performing well on this France exchange, because you can see that actually Allocation is one of them. You can look at LVMH, then you can see actually can't remember, is it L'Oreal also is another French stock. All these companies are actually doing quite well, and also they have been paying dividends. So that's why for me I'm still holding this stock, because I used to work in this company, something I just hold on all the way. Next thing is that this stock, they used to give a high profit margin, then the dividend payout around still sustainable. Their debt to equity has been increasing over time, and their earnings per share is slowly increasing. So I would say that more stable. Will you actually invest in this stock? So okay, this one is actually a Fraser center point. So actually they has been, I think there's some issue with this profit margin. Maybe I have to relook, because I think the numbers may not be 100%. Shouldn't be 100% if I'm not wrong, because there's something. So I will need to look into this ratio again. So Fraser center point is actually another risk has been actually growing over times. So you can see that the share price movement has been going over time. So recently with the COVID-19, there's a panic sell down, and subsequently actually has been going over time. So you can see that actually for a good stock, right, you ignore the profit margin. I think profit margin definitely they have some, the ratio maybe data may not be correct, but I can see actually their earnings per share has been actually stable over time, and also their debt to equity and their dividend payout. So that's why this kind of company, right, you can see actually the share price also slowly increase over time. So that's why you want to you only just use some of this ratio, but in case you want to actually further study about this company, you may have to look into all more ratios also. So now we need to put all this what we learn First of all, how to analyze, you did how to actually do case study. After that, how to put them into a portfolio. So just now I mentioned strategic asset allocation, client A and client B. So 30 years old and 60 years old, they have different risk tolerance. So one of the things we can do is actually call satellite strategy. It helps you to allocate asset according to your individual risk tolerance. Because sometimes we may want to choose some stock, but some stock we do not have idea. So maybe sometimes it's good to use certain ETF to actually help us. So that's where core satellite strategy can come into play. So what you want to do, first you have a core that actually help to anchor the portfolio strategic asset allocation. Sorry, your core holding should actually provide more stability to your portfolio. So your core must really meet with your risk tolerance and investment horizon. Then subsequently you add satellite around it to enhance the return or mitigate the risk. So it can actually be implemented by active strategy also other than strategic asset allocation, even through tactical asset allocation. So you can actually make use of both active and passive strategy. I think when I talk about this, maybe you get very confused. You just go back to client A. So what I want to do. So client A, I have 70% want to invest in equity, 10% cash, then the rest in bonds. So maybe I'll say that my core, I want to get passive income. So one of the ETF you can look out for is Sing Income ETF. There are also much more ETF out there. Just this is just an example. So 40% they can help me to provide returns. Then I think that Sheng Siong, just now we study, Sheng Siong, Frasers Centerpoint, and Airliquide will do well. So my rest of the 30% equity, I'll accept 10% to each asset. So one thing is that when you are doing asset allocation, right, usually I don't recommend clients to have allocate like 100% or maybe 70-80% just to one counter, because it's very, very risky unless you are doing trading. And also trading, you need to do cut loss. So that's why it's actually good to have a diversified, because sometimes during economic downturn, certain sector will be affected, certain sector will be not less affected. That's why it's good to always have diversification. And for bonds wise, maybe I'll consider Nikko AM bonds, then 20%, then the last 10% I'll put cash. So it's always good to have cash. So I think some of you actually came late. So this will be also replay. Later, I think we'll also share this replay link when we upload in the Telegram group. So next thing is client B, older generation, 60 years old. So I want to have a lower asset allocation. So I want 70% in bonds, so and 20% in equity, then 10% whole cash. So what I can do, Fraser Centerpoint, Sheng Siong, I can hold 10% each. Then ETF, right, you can actually for bonds wise, you can consider stable corporate bonds or maybe Nikko AM ETF. Then there's also retail bonds where you can also buy retail bonds in term of 100. So for corporate bond, the minimum amount is maybe SGD 250K, or maybe some of these are denominated in USD, is 200K USD. Then for retail bonds, it's actually traded in 1,000. So this will be actually more manageable for retail client also. So other factors when you want to consider as a portfolio, when you are looking for passive income, you'll prefer large mature company with more stable revenue and profit and cash flow. And it's good to diversify your holding 20 to 30. So sometimes it's very hard for us. You want to look at 30 company financial statement. I think it's a pain because to really understand the financial company statement, right, you take me around at least of 2 to 3 days. Imagine I have 30 stock, and 30 stock 2 to 3 days, 60 days is 2 months already. And some of these company report on quarterly basis. It's really a hassle to read. So that's why it's good to use ETF, where they help you to diversify into all these company where managed by fund manager. Subsequently, then you will also select a few stock that you really study, do a lot of study. From there, you do your asset allocation, like the client A, do 10% to 3 different stock. So always also do diversify holding with across different sectors. Do not just put 100% into technology. It can be very risky also, especially when there's technology sell off. So it's good to also have a higher percentage of non-cyclical stock as part of your portfolio, so that your portfolio will not be affected. Because cyclical stock, right, during economic downturn, they are more affected than non-cyclical stock. Include bonds to always diversify your risk. So a lot of clients also don't really consider bonds because they thought that bonds is very boring or 2-3% only. But in reality, right, you do not want to lose your sleep during a recession. So it's good to have some bonds inside your portfolio also. Last thing we'll come to actually talk about margin. Because just now is, let's say all this before the talk is that, let's say I put 1K, I purchase up to 1K of this stock. However, with margin, right, you can actually purchase more than 1K and increase your return. It's a margin is always a double-edged sword. It can amplify your return, it can also amplify your loss. So carry trade. So what is a carry trade? So we talk about bank, financial institute in Singapore, and the person. So especially with the low interest rate environment, some people, what they do, they'll borrow money at a low interest rate. Subsequently, they invest into asset that is likely to provide a higher return. Then the return from the investment, they use it to pay back to the borrower. So this is actually what we call margin or carry trade. And also you can see that actually some of these investments, right, may not be equity, some of this may be property. So you can see actually there are people who actually make use of this low interest rate, they invest into property. But do take note, you always need to take note of your risk tolerance and also what is your income, all this, and also how are you going to sustain all this before you do any investment. That's why you need to plan ahead, set your investment objective and goals before you go into all this. So how does this work? Let's say this client, you have 10K of this cash. So when you deposit 10K of this, he can actually purchase grade A, you can purchase up to 3.5 times, grade B 2 times, and grade C, there's no financing. So the grading of this stock, right, is actually when our credit department, all this, will do assessment of this, then they'll group these shares into grade A, grade B, grade C. So you can see, so what 10,000 can be buy up to 35,000 of grade A. However, I always tell my client, those who actually do margin, right, don't margin fully. Like even you have 10K, you can buy up to 35,000. Maybe you also want to lower your risk a bit. Maybe you just consider only 20,000 of grade A. So always consider your risk also. Let's say if you deposit 10,000 of these grade A shares, you also can, other than deposit cash, you can also deposit shares. So from shares, right, grade A, you also can purchase another 25,000 of grade A shares. So always remember, don't over leverage. So there's also margin requirement factors. It's actually calculated by system. So they help you to calculate what is the initial margin and maintenance margin, and what is the forced selling. So let's say if the share price movement move against you, right, then you actually incur a forced selling margin call. So during the forced selling margin call, then you have to see whether you need to do top up or you want to sell off some of your existing cash. That's why I always tell clients, do not always go all out, because you can see that market always can be very volatile. That's why you need to consider your risk and investment objective. So just talk about maybe talk about bond financing first. Let's say current there's bond A 4.5%, bond B 5%, bond C 4.2%, and financing rate is 2.68. Let's say if current A just buy without financing, he can buy bond A by 500K. Then because of this coupon, bond A give you 4.5%, give you 22. Okay, so on an average monthly returns is around 1K plus. So some clients, right, they actually do bond financing with us. So what they do, so bond A, they buy instead of 500K, they buy up to 1 million portfolio. So they actually do so-called double. Then they actually finance 500K. Then actually these two, right, because now you're holding a 1 million portfolio, they give you a coupon of 45K. Then do think that because there's financing charges, so your financing charges, let's say it's around 13K 400. Because of your 500K, you need to finance 500K. Then after that, your annual return is actually 31K. So in this case, they actually enhance their return to around 2.6K instead of the 1.8K. And some client, they go even higher risk, but do think that do not take more risk than what you can handle. So they use 500K to purchase up to 1.5 million of bonds A. From there, they get the coupon. Then from there, they can actually enhance their return. Do think note that all this margin, right, they actually amplify your return, but they can also amplify your loss. So you need to really handle carefully. So that's why sometimes you also need to do diversification also. So for this client, instead of doing, now you say, oh, actually 500K, actually I can consider 3 different bonds. So I purchased 500K of bond A, B, and bond C. Okay, this bond A, B, C is not grading. It's just a grade A bond. Let's assume it's grade A bond. So financing is actually 1 mil. So from there, actually I have to pay 1 mil up the 2.68%. These are actually the financing charges. Then this is all my coupon. After that, what's my minus off my annual what's my annual return? Then actually I'm getting return monthly return around 3.6K. So that's why there are clients who make use of this low interest rate environment. They use on margin, invest into a stock that or bonds or that give you higher returns. However, always think note, do not take more risk than what you can handle. If you really don't understand this after this, right, maybe it's good to talk to your trading representative. From there, they can actually advise you whether you are suitable or not, because not all clients are suitable to handle the margin also. So now we talk about portfolio, because let's say client A 500K, then financing rate is actually 2.99%. So what he can do, let's say equity from where have 350K asset allocation. What I can do, actually, I can actually allocate around 700K, because 2 times, consider I do 2 times. So without any financing, right, my return is around 4.4%. Let's say I do a double allocation, means that I buy 700K and bonds I buy 200K. Let's say assume return 5% and 4%. From there, actually, I do a calculation what is the financing charges based on the amount that I've financed. I can see how much return I can get. So actually, you can enhance your return a bit with the margin account to around 6% instead of the 4.4%. However, same thing, do not take more risk than what you can handle. Client B can also do similar thing. Let's say because you have 70% higher allocation towards the bonds, without financing it's around 3.9%. With financing, right, actually can enhance its return to around 5.11%. So these are for client. Just to share about these few examples. Let's say client have very huge capital, and maybe some client, right, may not have huge capital and they want to do margin. What they can do? So this is actually currency. Let's say I start off with 30 years old. Every month I will save certain. This is based on per year. So every year I save 2,000. Then I have around 10K to invest. What I want to do, maybe I also do double allocation. So 10K I invest into 20K portfolio. So let's say give me around 5% return. So I bought 20K. Subsequently, every year I put 10K, invest, my portfolio slowly grow over time. So my annual return also slowly increase over time. However, when I grow old, right, what I want to do, I also want to actually invest into fixed income. So subsequently, instead of buying just stock, I'll start to buy stock and bonds. So I'll choose 50%. When I grow older, right, maybe I also consider, I don't want to buy any stock. I start to increase asset allocation towards bonds. So this is actually another way that actually clients can actually slowly increase their annual return over time also, how they actually can do investment. So this is just an example that you can see. So one thing is that if you want to do margin, right, first of all, you need to understand the risk. Do not take more risk than what you can handle. In case you still do not understand, please contact your trading representative. So I think currently there's our share financing rate from the margin department is around 2.99%. And in case you are doing bond financing, right, the bond financing rate will be actually lower, just contact your trading representative so they can find out for you. So in case you want to look at our past webinar, these are the 3 ways that you can do. Visit Phillip CFD website, click on education, then click on the videos, or visit PhillipCapital Facebook group. You can see all the videos, or YouTube. And our upcoming webinar, you can visit the education. Later I'll show you. So I think let's go into some questions. Okay, so someone has asked, what are some of the consumer staples that we actually can consider? I'll say that Sheng Siong is one of them that you can consider, because consumer staple means that these are needs that we always require regardless of economic up or down. Because economic go up, you still need to eat. Economic go down, we still need to eat. So this kind of Sheng Siong stock, right, is considered stable. It's more resilient. Other consumer related, let me think. I can't really think of. NTUC is not listed. Another one is actually dairy farm, but dairy farm there's it's not just purely grocery, because they actually have a wide range of business also. So that's why can't really think of much other than Sheng Siong. Overseas there's Walmart, all this that you can really consider also. Okay, someone actually asked, are this ratio actually available from a company financial reports? So I will say that okay, first of all these company reports, right, they may not show you the all the every ratio that we mentioned just now. Let me go back. Some of these ratios that they may not be showing. So in that case, right, then you may have to do your calculation, because net income margin, most of the time you calculate. However, some of these like interest coverage ratio, right, they may not be calculating other than REITs, because there's a requirement for them. So that's why you still need to understand some of this ratio. In case you need help in calculation, right, just find a trading representative. They can show you the formula, explain to you a bit on how to actually look out for all this. Also, maybe you just go to SGF website. Give me a moment. So some of this ratio, they also may be actually in the SGF website. Okay. Just go to okay, how to find those financial ratios, right? You just go to security, price, screener, and then go to price, and then let's say just go Sheng Siong. Click on financial, they'll give you some of these ratio, current asset, all this, and if you want to look further, they show you the past few years. Let me see, that's the ratio. So some of these ratio can be also like quick ratio, current ratio, all these can be also found over here. Then debt to equity, they did debt just not mentioned, the expand also. So other than this, give me a moment. So you can use our stock analytics. So from here, you can also find out some of this ratio. So from here, you can get some of this ratio over here also, or some of this figure over here. So these are the 2 websites that you can use to get this ratio. So now I think second part of this, so for a financial representative from PhillipCapital, make recommend to your client, do they actually study this ratio? Wow, this is very tough question. For me, actually, I do consider all this ratio when I actually make any recommendation to my client because I have to see all these company are really doing well. So I would say that for the financial representative, right, when they do all this, right, they may not be able to. I'm not sure whether they look into every single ratio, but by right, we need to actually study all these companies, see whether they are really doing well before you actually do any recommendation to our client. So do points provide chart? Chart wise, you can just go to chart. Then from there you can see the chart. But for chart wise, they don't actually do any analysis. So if you want to do any analysis, you can use for chart wise is mainly for trading, more for trading, or you're looking for potential support level to buy. So there's chart risk and also trading central. Chart risk is actually a so-called a screener where they actually look out for potential sign for you to look out for bullish or bearish stock. And also trading central, they will give you trading ideas over here. On another website, you want to look out for analyst reports, you can visit the Stock BNB website. This is actually by our Phillips research team. Maybe I share this, just share this. Then this is one of them that you can understand. Then another one is actually, because Philip, sometimes I want to look out for more analyst reports. And SG Invest.io. This is another popular website for Singapore stock. Yeah, so you can see the company name. So this one I share the link over here. Then in case I want to look out for foreign stock, right? Sometimes I actually look out for this website, Seeking Alpha. This is very useful website that I use. Help me to understand more of overseas because we may not be physical there. So from here you actually can see some of this top trending stock, what they are doing. So from there you can understand overseas. Like you understand Alibaba, they can read out all these articles. These are 3 useful websites that I always make use. So in case okay, maybe you go to next one. I think chart wise I already shares information. All this you can find over under news, stock analytics and charts. Okay, so someone asked for some good dividend stock. Okay, actually I would say that REITs wise most of them actually are good dividend stock, but one thing is that you have to look how the REITs is managed. So I would say that generally like REITs that related to CapitaLand, Fraser and Mapletree are more well managed because of the strong sponsor. They manage the REITs well and they have interest in that. So some of the REITs that you can continue to keep a lookout for, I think our analysts actually have discussed. Fraser Centerpoint. This is, I'm a bit biased because I love Fraser Centerpoint. It's Woodlands and something that I can look out for. So this is an analysis report. So they give a target price of 2.79. So what they discuss, you can read up these reports in the Stock BNB. Another one I think you can see is actually Ascenders. Ascenders 3, I think recently have come down because of the rights issue. Fraser Centerpoint, I think a few months ago they also did come down. Subsequently, only recently they start to move up because of the right issue. So you can see actually a lot of REITs, right? They actually are doing so-called buying property at this point of time. Why they are doing this? Because they are also doing what you call carry trade because of low interest rate environment, also the low property price. They want to actually get at this opportunity, invest into all this property that can actually generate return in the future. So that's why REITs so-called they are also doing a bit of margin carry trade also. So this Ascenders REIT reports. So I expect REITs right in the next coming few quarter, right? You can expect a lot right issue preference offering when they see opportunity in market, they want to buy, make use of this low interest rate environment, they'll continue to do purchase. So if you're holding REITs, right, you also need to have a bit of spare cash to subscribe for all this. So this analyst report, they give a target. I think they also do risk reports. So they did what are the risk reports. This one you can share this. You can read up more. So they give a view on what are some of the risks that you can keep a lookout for. I think Escort is something that you can consider. Escort has exposure to the hospitality. So when you ask hospitality in the future, maybe one year down the road recover, Escort will be also beneficiary. Another one actually I think is not under here. Maybe want to look at is actually CapitaLand China with let me see. I can't remember the name. CapitaLand China Retail, if I'm not wrong. Okay, never mind. I use this. China, because you know that actually for so-called CapitaLand, right, they actually intend to expand from currently around 1.5 billion assets to around 500 billion assets. 1.5 to 5 billion assets in China over the next few years. So you can see that actually CapitaLand Retail China Trust will be one of the way that they can actually expand this holding over time. So if you want some exposure, you can get some exposure in this. I expect them to do well. However, do expect, because they want to grow assets over time, so expect a lot right issue and preference offering over time. Then for some other dividend stocks, so some people may also use stock screener to do screening for dividends. That's why I want to check dividend stock. Okay. So I can do a screening, maybe around 6%. Then they help me to do screening from there. Then you help me to do a screening. After that, you still have to look into the individual fundamental of the company before you actually invest. So you can adjust your filter. You can use more filter, what kind of PE, all this, you can make use of this to do screening. So you can see China CapitaLand Retail China Trust is one of them that you can look at. Yeah, so some of the stock just come back. I think Frasers Centerpoint I expect to do well. Ascenders, CapitaLand Retail China Trust you can look at. Also some of these Escort. All these REITs you can actually take a look. Then for overseas dividend stock, right? Overseas, I would say that if I'm looking at US, I'm more looking at growth stock because of the 30% withholding tax. So I don't want to be affected by this. So for this case, if I'm investing overseas, I'll go for actually more growth stock. In Singapore wise, I'll keep it to dividend stock. So always depend on how you want to invest. Top 10 best, it's very tough. That's why I say some of this you can look at. I will say that Ascenders, Frasers Centerpoint, Escort, all this, Capital. Okay, bond financings, right? What are the risks? So depend on corporate or retail bond. So let's say if bond default, right? So that's why you need to understand the fundamental of the company. Just now, all this ratio, right? If you are investing in stock and or bonds, right, you still need to look at the fundamental of the company. So for bonds, right, if you actually, let's say you leverage onto margin bonds, and in case bond default, you actually then you will not be able to get back the capital, and you may have to actually pay out for the margin. So that's why margin wise, they always have amplify your return and also amplify your loss. So I think just now, that's why you need to understand the bonds or this. Corporate bonds is actually in terms of 250K. Maybe just find one bond to discuss. Okay, just now we talk about, maybe we'll talk about the Capital and Retail China Trust. So actually one bonds, right? Let's say I want to buy one bonds. The nominal one is 250K. So they tell me what is the indicative price. Then what is the indicative yield? Because bonds, right, unlike stock, bonds, right, when you are holding one day, right, you actually get accrued interest on a daily basis. So you can see there's accrued interest, not like stock. If you actually do not hold until the XD date, then you do not get the dividend. Bonds is different. On a daily basis, then you actually accrue interest. So this is actually how you can look at bonds. All these are actually corporate bonds in terms of 250K. So there's a wide range of bonds. It's not just Singapore bonds. We have bonds from overseas also, and also different currency. They are trading in different currencies. So, and some of them, maybe upcoming we will have a bond webinar, because bonds wise, there's a lot term that we need to talk about. What is perpetual? What is their maturity? What is the first call date? So in this case, webinar, I think I won't talk about this. We'll have an upcoming webinar to cater to talk about more bonds, so they can explain in more in depth on bonds. I think just now we saw about company historical data. All this you can actually from SGX or from the points just now the stock analytics, you can get all this data. Well, someone asked whether is it a SIA a good recommendation. If you ask me inside the, I think I have mentioned inside the Telegram group a lot. I always take SIA pen, but I will never buy SIA stock, and I won't buy any airline stock. Why is it so? So because first of all, for me, airlines, right, they have to incur a huge debt, means that they have very high capex. Maybe I go back to a slide. To buy an airplane, you need a very high capex, and to maintain all these airplanes, right, you need to have a high maintenance cost also. So that's why I don't really like this idea of high capex stock. Next thing is that in case of any economic downturn, tourism will be the one of the things that recession. Tourism will be the one of them be very affected significantly, because when we don't have really our daily so-called our income are affected already, what things we can cut down? We won't really cut down on food, all this, but we will definitely cut down on travel, all this. So tourism is very affected. So airline will be very affected. Next thing is that you talk about oil price. Oil price fluctuation is very significant. You can see you go up from 20 to 100 USD, 120. After that, you collapse all the way down again. So oil price is very hard to do hedging, and you can see a lot of airline, right, when they try to do oil hedging, they actually incur very huge loss on all this oil hedging. So that's why they are very affected by oil. And also, airline industry is very competitive. So let's say you book an airplane, you compare all the different sites. Wow, which airplane actually give me the best discount? So you can see airline industry is very competitive. So based on these four reasons, I will never invest in airline stock at all. That's why you ask me I won't invest in that. Airliquide is actually not in Singapore. It's actually in France. Let me go back. Where's my? So actually, Airliquide is actually a France stock. Okay, maybe I use TradingView. So if you are looking for trading idea, TradingView is also some people that use. This is a stock Airliquide. Then others, so you can see actually long-term wise how their performance. Yeah, they're going over trend. Just now I talk about LVMH. You also can take a look from them. So you can see actually this stock are in the first. There are quite a lot of stock that actually do perform well. L'Oreal. Okay. Wow, okay, I think there's quite a lot. They are listed in, if I'm not wrong. Okay, I can't find the exact one, but you can see actually they also do perform well. So some of these stocks actually listed overseas that you can take a look. But also have been performing well over times. Okay, my view on Kappa, DC REIT, Fraser, Logistic and Commercial Trust, and Parkway REITs. Maybe you go back. Okay, so for Kappa DC REITs, right? Actually, analysis is actually a more neutral call because you can see that actually Kappa DC REITs, the price has actually go up significantly. Let me show you the chart. Because due to the resilient factors, right, actually the price range actually go up very significantly. I just can maybe show you the past 5 years. When I actually first looked at it, it was around $1. Now it's around 2.74. So around $1. Now it actually go up. So I would say that long term wise, capital series tend to be a bit more expensive. And looking at the current price range and the dividend yield, I think for capital series, you look at the dividend yield. I would say that it's not so attractive to me at the current price range already. Although I will expect them to do well, but I won't expect to add. So you can see, let me see here. Okay. Yeah, currently are trading around 2.2 times, 2.3 times of their book value, and the dividend yield is around 2.6%. So for me, for my risk appetite, not attractive. For me, I'm looking within range around 4 to 5% because do take note that everyone have different risk appetite. That's why you need to understand what is your risk appetite and what is your overall portfolio. You need some portfolio that have lower risk, middle risk, and higher risk. Higher risk, you will tend to put very low allocation, or that's why you have to look at overall risk appetite. For my risk appetite, capital series is not attractive, and the dividend yield is not attractive to me. Then Fraser Logistic Trust, I think for me, this one I would say that is something that I will take a look. So currently is well trading. The first let me see. Okay, the price to book is around 1.22. Then the dividend yield is around 5.274%. I'll say that for Frasers and the logistic and commercial, right, they are doing more of this logistic. They have actually quite a lot in Australia and also overseas. So I say I expect them to do well, especially with e-commerce trend. So e-commerce trend, logistic is one of them that will actually benefit from this trend. And Parkway, I think Parkway is also tend to be a bit more expensive side. I'll say that for me now, I'm looking for, just now I mentioned Escort, all this will be something that I'll consider. Yeah, this one I'll say that currently is also on the high side because of the defensive. So maybe when they really come down for correction, then you'll consider. I think they didn't really calculate. So another website you can look out for dividend yield. Let's say you just look out Parkway. There's actually dividend.sg. So this one actually help you to do the calculation for all these dividend. So you can make use of this website also. Quite useful. But one thing is that don't just look at dividend to invest. You need to actually look at the fundamental of all these company before you actually do investment. Okay, bonds wise, someone asked bonds wise, you can actually go to Point's website. Just now click under bonds, you can check out. Okay, real estate stock similar to airline. Okay, for real estate, right? Not really similar because it's I would say that they do have high capex, but they actually do generate revenue over time also. And I would say that for property wise, right? Actually, you see property, right? They do appreciate in price, but for airlines, they actually depreciate in price. Let's say you just see your HDB 10 years ago and now the price actually has been slowly increasing over time. So property for airlines is different. In case you actually want to get into tourism play, right? I would say that you consider those tourism related stock. Like okay, some of them you can look at is actually trip.com. All these are actually they do not have to incur huge debts and they are still servicing booking.com, all this. And upcoming, I think the most everyone will be looking out for is actually Airbnb IPO. You'll be actually listing soon. So this is some stock that I will even take a look at because I don't want to actually incur those so-called airlines that have very high capex and subject to very downturn. So all real estate, right? Sometimes they are vulnerable to downturn, but they are depending on what kind of downturn also. Like COVID-19, the tourism sector will actually definitely affected. So if REITs are going to buy property with low interest rate, so does it mean that debt will increase? Yes, depending on how they're actually going to buy this property. That's why they do balancing. They need to actually get additional funds from the existing shareholder through preference offering, then also private placement, also issue of bonds also. So they for REITs wise, they can actually make use of all these different. So that's why a good REITs, right, they need to make use of different ways of funding to acquire asset. They don't just depend on debts alone. They don't just depend on equity alone. Telegram, give me a moment. Let me find the link. Telegram group, I just share inside. Okay, my view on sets are actually for me, sets is another good exposure if you want to actually have tourism. Because sets you can see that actually for them they don't actually have to incur very high huge debt. One thing is that sets I hope them to actually do is actually more of automation, less reliance on human, because when they do automation all this, then they can actually increase their efficiency, how to automate the uh, baggage handling all this. So it's something like that. So for sets wise, I would say that tourism, when actually we can start to travel, sets is one of them that you can benefit. And sets is not just present in Singapore alone. They're worldwide. They are present in KL, they are present in China, they are present in Dubai, all this. So you really understand the business, right? Then you can see that they are not just really depending on Changi Airport alone. Okay, let me see. Okay, how to read support level of stock. For this time round, we won't be really cover about TA. So one of the way we want to look at support resistance, right? Just a very short one. Just go to maybe Singtel. I think a lot of people are talking about Singtel, especially they got the digital bank license. Then people there'll be a lot of concern. Let's go to 15 years. For the support resistance level, right, you can actually visit our past webinar. So I think okay, I think I select too much data. Give me a moment. Oh. Okay, maybe you can visit our past webinars. Education. All our past webinar we talk about all this support resistance. You can visit some of these webinars to understand more. People say they're asking look out for next correction. I'll say that the next correction may not come so fast because may take a while, because you can see actually for all the government and the world, they actually continue to roll out stimulus to actually support this economy. Unless there's any trigger, then there'll be a correction phase, but unlikely in the short term wise. My view on Top Gun and MedTech, I would say that those are very speculative. All these healthcare growth stock, right, they're very speculative nature. So that's why I won't really invest in this speculation nature. Because today our focus is not trading. Our focus is passive income, building a sustainable stock. So I will prefer not in the speculative nature stock because their dividend may not be actually sustainable. So I think, let me see, any last two questions before I end off because it's getting late. Let me see. Okay, someone asked about the business performance of Phillip Security. Okay, I would say that for this year's wise, right, we can see a lot of clients actually open up security account and they are doing trading or investing. I think partly because they are working from home, or some of them they may have more free time when they work from home. So they see actually there's an increasing trend of client investing and trading this year. So I would say that throughout all the broking firm, right, they expect to do well. That's why iFast has removing the digital bank license. I think iFast has been doing well. Also, UOB, KN, I expect them to also do well, especially in the broking side of the firm. Okay, someone has mentioned that okay, some of this stock has been actually run out a lot. So that's why you may actually consider investing over a period of time. Do not do lump sum investment. So do dollar cost averaging or value averaging, because market will always continue up and down. So using dollar cost or value averaging, right, can help you to do invest over a long period of time. And also some of the long-term trend, what you want to see is actually stock is towards the clean energy, EV cars, or these solar energies. I expect them to do well. Then also technology trend, IoT, automation, I will expect to continue to do well. So this stock that I invest in this industry will continue to do well. Okay, I think maybe we have come to end of the webinar. I think there's still some question, but we'll have to end off here. Okay, last question, just about bonds. So bonds wise, you can just, if you are looking for retail bonds, right, what you can do, you can go to over here, retail fixed income security. From here, you can see the retail bonds. I would say that retail bonds, right, they may have quite a limited choice. I share this over here. So these are the list of retail bonds that's out there. From here, you can check. I think currently these few. Okay, if there's no other question, we'll end off here. Then okay, I think what we'll do, maybe we'll cover upcoming webinar. We'll look into bonds, because I think there's quite a lot of question on bonds where I see what is corporate bonds and how to actually study bonds. So we'll look into a webinar on bonds. Then I'll work with the bonds desk to come up with that, because we actually have a bond desk that, so from there we can work with them to come out with the upcoming webinar for bonds. Then also, okay, maybe just to end off, can help me to do a feedbacks and see what kind of webinar do you want to see in the future. Then from there, we try to cater more towards the webinar that you want to know more about. Then from there, we can come up with more interesting topics. Maybe you also can look into EV car, clean energy in the future webinars on that. Okay, thank you. Oh, yeah, we'll come up with webinars. So you can help me to do the feedback. From there, you see what kind of topic you all are interested. We'll do partnership or come up with to study more about this and share all this information with all of you. Then in case you are interested in margin, you can contact your trading representative to understand more about that. Thank you.